There's lots of times when it makes sense to do Roth conversions, but there's a few times when you shouldn't do Roth conversions, and one of those reasons just expanded thanks to the new tax laws. I'll warn you of that, tell you what to look out for, that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. You know, if you're a fan of the Wise Money Show, love the Roth conversion. Love the Roth, really. And really, it's all about tax diversification, having some of your wealth growing pre-tax and some of your wealth, hopefully more and more of your wealth, growing tax-free, out of the reach of Uncle Sam, where all the dividends and capital gains don't land on your tax return, and as you withdraw dollars, it's tax-free. Well, it's not one size fits all. There's a lot of times when you should be funding the Roth or maybe doing Roth conversions. That's shifting dollars from an IRA or pre-tax dollars into the Roth. When you do that maneuver, it's taxable. It's a taxable event. But then you have more of your wealth growing in that Roth IRA, that tax-free bucket. Lots of times when you should do that, really more times when you should do that than people are currently taking advantage of. So make sure you're doing that proactive tax planning work with your CFP. But there are a few reasons, a handful of reasons or times rather, when you shouldn't do a Roth conversion. Recently made a video on that, but since that video, we've had the passage of the new tax laws. And I'm afraid to tell you, one of those reasons, one of the times when you should not do Roth conversions actually just got expanded because of the new tax laws. That's right. When you are in a situation where doing a Roth conversion is going to cause you to lose out on some tax benefits that you otherwise would be eligible for, maybe some deductions or credits, that's a time when you probably shouldn't do a Roth conversion, or at least need to do all the math and think very long and hard about it before you do the Roth conversion. Here's an example: being unaware of your tax situation, then all of a sudden you do a Roth conversion and wham, you get hit by the Medicare surcharge for your Part B and Part D, IRMA. Meaning, if you wouldn't have done the Roth conversion, your adjusted gross income would have been below that threshold, and therefore you would have just paid the base rate for Medicare Part B and Part D. But because you did the Roth conversion, you weren't aware of those thresholds. You didn't realize it was going to push you over that modified adjusted gross income threshold, and you did the Roth conversion anyway, and then all of a sudden you had to pay the IRMA surcharge. Those sorts of things where you increase your modified adjusted gross income or your adjusted gross income because of a Roth conversion, not realizing that there were some consequences, not realizing that you were getting some tax benefits that now you're giving up because of that Roth conversion. That's one of the big times, one of the three times that you need to think twice before doing that Roth conversion. Well, there's a lot in the new tax laws that are benefits, either a deduction or some sort of tax benefit that you don't get if your income is above certain thresholds. And specifically for those of you right on the verge of retirement or in retirement, there's a couple that if you do a Roth conversion and unknowingly put yourself above those thresholds, you can lose out on some of the benefits inside that new tax law. One is the senior deduction, the new senior deduction I'll explain. The other one is the state and local tax cap, the SALT tax cap. Let's get into it. So the new senior deduction was originally sort of coined, and no tax on Social Security, they couldn't pull that off. And instead, what you get is if you're eligible, if your modified adjusted gross income is below certain thresholds, there's a $6,000 deduction if you are age 65 or older and your income, your modified adjusted income is below certain thresholds. What are those thresholds? Married filing jointly, it needs to be below $150,000. If you get above $150,000, then some of that deduction, some of that $6,000 deduction starts going away. If your modified adjusted gross income exceeds $250,000, then you don't get any of this new deduction. And again, married filing jointly, $6,000 per person, that's a $12,000 deduction. And you get that, apparently, whether you're going to be taking the standard deduction or itemizing. So this could be a very lucrative benefit. Say, for example, with your Social Security, maybe your pensions, maybe some dividends, interest, and so on, and withdrawals from your IRAs, you're already pretty close to that $150,000 as a married couple. And in doing some work, you've looked and said, you know what, we need to start doing some Roth conversions and help limit and lower our required minimum distributions out there in the future, or whatever the reasons may be. And you start doing Roth conversions, all of a sudden you could lose out on this tax benefit, and potentially, if you do enough Roth conversions, get your adjusted gross income, modified adjusted gross income above 250, lose the deduction altogether. Similarly, with the state and local tax deduction, the new SALT cap has been expanded with the new tax laws. Previously, the state and local tax deduction, if you're going to itemize, was capped at $10,000. So if you're going to itemize and add up your mortgage interest and your charitable contributions, and then the state and local taxes that you pay, that state and local taxes section, the maximum that was allowed as an itemized deduction was $10,000. Well, they've increased that to $40,000, a big, significant increase for lots of you that pay high property tax or live in high state tax areas. This could be a big benefit, but your income needs to be below certain thresholds. Much broader spectrum for this tax deduction than the senior deduction. Your modified adjusted gross income, you get the full benefit all the way up until $500,000 of modified adjusted gross income. But from $500,000 to $600,000, that's where it starts phasing out. And if your modified adjusted gross income exceeds $600,000, then your state and local tax cap deduction goes from $40,000 all the way back down to $10,000. You might say, I'm not doing Roth conversions if my income is that high. I know, but a situation could be that you are maybe moving, or maybe you're harvesting some capital gains or have some other assets that are landing on your tax return, but are taxed at capital gain tax rates. And so you might look and still say, no, we're still in a decent ordinary income tax situation, and let's do some Roth conversions now, again, before required minimum distributions or to get more of your wealth growing tax-free. So even though your income, your modified adjusted gross income, is near these levels, you still might be in an attractive ordinary income tax bracket and might consider doing Roth conversions. You got to be careful and be aware of this threshold and where you expect to land so that you don't inadvertently cause your state and local tax deduction cap to be lower than what it otherwise would be. These are just two examples of the proactive tax planning work that you need. Tax planning is one of the 6 areas of your financial life. It's different than tax preparation because tax planning is proactively looking at what opportunities exist for you to improve your tax picture, pay the least amount of tax over your lifetime, whereas tax preparation is reactive. It's just looking and saying, well, what happened last year? Let's get the right number in the right box. In order to take advantage of Roth conversions when they make sense, you need that proactive tax planning work, as well as being aware of, well, what trade-offs could doing too much Roth conversion actually trigger, and I want to avoid. That's tax planning as well. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go on and take your next wise step in your financial life.